So it is the topic 2 of the financial management. That is portfolio theory and analysis. Portfolio, portfolio theory and analysis. Portfolio theory and analysis, where examiner wants you to look at the expected rate of return, the the capital market, capital asset. You need to see the type of risk, because our portfolio, when we talk of portfolio, we are talking of several collections. We are talking of several collection of investment, several collection of investment. Maybe you have invested in a real estate, the manufacturing company, the service industry, then all that we call the portfolio. Portfolio. So it is a collection of what? Several investment. So as I have said, in a definition, you say a portfolio is a collection of investment, or asset, that is the first definition. And then the next point, you say investors form a portfolio. Investors form a portfolio in order to minimize the business risk. So the investor form portfolio in order to minimize what? The business risk. Because it's like if you put if eggs in one basket, if it falls, then it will all you end up losing everything. So a good investor will have several portfolios so that he can't minimize the risk. So what is a business risk? So let's define what is a business risk. So you say refers to fluctuation of cost of earning, And then to say a business risk has the two components. Another point, you say a business risk has the two components. We have what is called systematic risk. And systematic risk. So there is the one which this one is unsystematic. It can be reduced by a portfolio. Another one cannot be reduced by several portfolios. So let's define what is a systematic risk and say systematic risk refers to the risk that cut across all the business. So it refers to the risk that cut across all the business. So it is the risk that cut across all the business. So you say that. And then then we have, so systematic risk cannot be what? Cannot be diffused or reduced. Yes. So this one cannot be reduced by several portfolios. So you can put another point and say systematic risk cannot be reduced. Then we have unsystematic risk. You define and say it is the component of business risk. That does not affect all the business of an economy. Then another point, you say it is also known as the company specific risk. So, and investor can avoid this unsystematic risk. So we have the curve of this systematic risk and systematic risk. So here you have what is called business risk, and down here we have portfolio. Size. Here is portfolio size. So we have a curve here. This curve, this down here is a systematic risk, and up here is unsystematic, and systematic risk, and systematic risk. So you can have that curve, you can have that curve, you can have that curve. So we have the exam forecast area. So examiner is focusing, not, we don't have a lot of theory, so you will read a lot of theory, but examiner focus on, examiner focus or exam focus, we talk of what? That is expected return. So exam want to know expected return, or examiner want to test you on expected return, and security of portfolio, and security of portfolio, and security of portfolio, and security of portfolio. Another concept examiner wants you to understand is standard deviation, and coefficient of, and coefficient of correlation, and coefficient of correlation. Another concept the examiner wants you to understand is performance appraisals, performance appraisals using Jensen's method. So we have several methods there, alpha method. And then another one, the portfolio equation, which is Elias the Capel. So can we have now how to get this expected return, how to get expected return, how to get expected return. So we can have a simple illustration here. We can have a simple illustration here under the expected return, under the expected return. So expected return is the profit you are expecting to earn from an investment, So just write expected return. You can start with expected return. So you can have illustration. We have profitability for exercise 1. We have drops, that is 0.3, 0.2, and 0.5. We have the return X, and we have the return of Y in form of percentage. This return should be in form of percentage. We have 10, 8, we have 10, 8, 3, Here we have 2018, 7. So these are the probabilities and the expected return. So how do you get the expected return? Expected return is the probability times the return. The probability times the return, the probability times the return. So my good guys, if you have been asked to get the return here, just get what? The summation of this plus that what? That is the required is that determine the expected return of the above securities. Determine the expected return of the above securities. So we can have the expected return of X. So I will take the probability 0.3 times 10 plus 0.2 times 8 plus 0.5 times 3. How much am I getting? I'm getting, if I use calculator, getting a return of 6.1. So that is my return. What about expected return of Y, of project Y? I will repeat the same procedure. Times 20 plus 0.2 times 18 plus 0.5 times 7. How much are we getting as expected return? So we're getting expected return of 13.21. So that's how you get the expected return of a simple illustration. That's how you get a return. What about the standard deviation? If you're being asked to get the standard deviation of this return. So how do you get the standard deviation? Standard deviation is a measure of return. If it is, for example, return of X, you take the return of X, minus expected return of X. We do what? We multiply by the probabilities. And remember to square this. Then you get the root of this. You get the root of that. So that's how you get the the standard deviation. So if you are to get the standard deviation of this project, already we have this expected return, we have this expected return. So first, because the standard deviation is same as the root of what? The root of variance, the root of variance, root of variance. So can we get the variance of this project? Can we get the variance of this project? Can we get the variance of this project? Yes. So let's get the variance. Let's get the variance. Let's get the variance. So the variance of this project, I will take the return that is 10 minus expected return 1.1. 1.1, you do what? You multiply by 0.3. How much are we getting? Then 8 minus 6.1, I multiply by 0.2. 3 times 6.1 minus 3.1. Then remember to square this. Remember to square that one times 0.25 and 0.5. So remember to square this. Remember to square this. So the first one I'm getting a 4.56. 4.56. You can have two days more place. The second one is 0.7. 0.7, how much? 0.7 22, 0.722. The next one is 4.805. So if you get the total, 4 plus 4, 8. So if you round off that one, it will come to 10.09. 10.09. So that is variance. So let's get the root of this variance so that we get the standard deviation. So let's get the root of this variance so that we get the standard deviation. So my standard deviation here will be root of 10.09. Root of 10.09, which I will get my standard deviation as 3.8. So that is our standard deviation. That is our standard deviation. So here I'm trying to build concept. So CPA is getting concept. CPA is getting concept. There's no need to do a complex question without you having this knowledge. So you must get this knowledge first. You must get this knowledge first before what? We go to advanced side. So what about if you have been asked? What about if you have been asked to get the covariance between y and x? If you have been asked to get the covariance of x and y. The covariance of x and y. So how do you get it? So covariance simply means it is the shared variation, because this is the variance. So covariance, that's what it means. You are sharing this variance. You are sharing this variance. So it is the shared variance. That is so you have to take the difference between the variance. So the covariance here, you take the difference between the variance of x, times the variance of what? Of y. Then what you do? You multiply by the probabilities. You multiply by the probabilities. So I will take the expected return. That is summation of expected return. Sorry. Can write here. That is return of x minus summation of return of x into return of y minus summation or expected return of y, not summation, expected return of y. We multiply, then you get summation, you multiply by the probabilities. Already we have gotten the standard deviation of project of the return x. So you can go ahead and get the expected return of y. You can get the covariance of y and then get the standard deviation which we can get that one. So if you can get that one, so I will not going to repeat again because it is the simple. So make sure you do the same procedures. So let's get this covariance. So we will come and take 10 minus expected return. That is 1.1. What do? We multiply by expected the return of y, which is 20 minus the expected return of y, which is 13.1. We do what? We multiply by this probability 0.3. How much are we getting? We come to the second return, that is 8 minus 6.1. We multiply by 18 minus 13.1 and 0.5, 0.2. This one is 0.2. Then we take 3 minus 6.1 times 7 minus 13.1 times the probability 0.5. So how much are we getting? For the first one, I'm getting 8.0, 8.073, 8.073, 8.073. What about the second one? The second one, how much are we getting for the second one? So let the calculator. Let the calculator. So the second one, you take 3, can put the bracket will 3 minus 6.1, bracket 713.1, bracket times 0.25, getting a 9 point. This the last one is 9.455, 9.455. The same case, you take that one. For the second one, 15 minus. So put the bracket, all the bracket in your calculator times 0.2. This one is 1.8. So you add the 3. The total will come to 19.339. Total is 19.39. So that is now the covariance. So this one is the covariance. This one is the covariance of x and y. This one is the covariance of x and y. The covariance of x and y. So we are always covering all these topics the examiner wants to focus. Now, after the covariance, what about the correlation of coefficient? The correlation of coefficient, the correlation of coefficient, the correlation of coefficient. How do we get the correlation? A correlation, correlation, uh, correlation of coefficient of x and y. Coefficient of correlation of x and y. Coefficient of correlation of x and y. So to get the correlation which we stand by R, correlation of x and y equals to the covariance of x and y, we divide by the standard deviation of x and y. We divide by the standard deviation, of x and y. So we have already gotten the standard deviation of y, x. So it is you now, you get the standard deviation of x. So correlation is 19.39. We divide by the standard deviation, which we already get 3.18 times the standard deviation of y, which is 6.1392. So that one will give you correlation of 0.9. So correlation should not be more than 1. Correlation should not be more than 1. So if you have a correlation which is exactly 1, that is a strong correlation. That is a strong correlation. So if it is to comment, you give the comment as what? A strong correlation, as a strong correlation, as a strong correlation. Now, I want to go to the now. That was the simple standard deviation, the correlation of covariance. Then we go now to the advanced part of this financial management, where the examiner will ask us to get the expected return of the portfolio. 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 So in advanced part, the examiner will need us to get the expected return of portfolio, which we write as ERB. That is expected return of the portfolio. So expected return of the portfolio, we must have the weight. So the examiner should give us the weight for us to get this portfolio. The portfolio, they should give us the weight, and weight equals to 1. So if we are asked to get the expected return of the portfolio of X and Y, the weight of X and the weight of Y should be equal to 1. Should be equal to 1. That is the weight. So let's use the previous illustration and say assume assume or assuming a weight assuming weight of X is 0.2, assuming weight of X is 0.2 or 0.3 and of Y is 0.7 and Y is 0.7 and Y is 0.7 and Y is 0.7. And then say using that illustration, which is we add the probabilities, that is 0.3, 0.2, 0.5, we have the return of X 10, 8, 3. Then we add a return of Y 20, 18, and how much was it? 18 and 7 and 7 and 7. And then required determined the expected return of the portfolio. Required determine the expected return of the portfolio. So they are given you weight of X and Y being 0.3, and they've given you the weight of Y being 0.7. Then this is the return. So it requires you to get the expected return of the portfolio. The expected return of the portfolio. So how do you get this expected return of the portfolio? So to get the expected return of the portfolio, my friend, good friend, get the expected return of the portfolio, you take the weight of X, times the expected return, of that X plus the weight of Y times expected return of Y times the expected return of Y. That's how you get the expected return of the portfolio. The expected return of the portfolio. So in our case, 0.3, and we add 1.1 as expected return plus 0.7 times 13.1. That is our expected return. So what is this expected return of the portfolio? So you will take 0.3 times 6.1 plus 0.7 times 13.1. I'm getting the expected return of the portfolio. The expected return of the portfolio is 11. The expected return of the portfolio, 11. And then after that, getting the expected return of the portfolio, after getting the expected return of the portfolio, how do you get the, or how do we calculate expected standard deviation of portfolio? So let's get the standard deviation of the portfolio using these values. Then we get the standard deviation, of portfolio. The standard deviation of portfolio. So let's have the formula. So already we have the values. We will not write any values here. So to get the standard deviation of portfolio, we will use this formula. So you say square root of what? that one. So we need to square that one. So we say the square root of what? We have to get the weight of x squared times the standard deviation. How do we write the standard size of standard deviation of x plus the weight of y squared times the standard deviation of y times the standard deviation of y plus 2 into the covariance of x and y into the covariance of x and y plus this is the covariance of x and y times the weight of x and weight of y times the weight of x times the weight of y. That's how you get the standard deviation of the portfolio. The standard deviation of the portfolio. You have to get the weight of x, which they are given as 0.3. So if we replace it here, we have the weight of x, which is 0.3 squared. We add the standard deviation of x, which is 3.18 plus the weight of y, which is 0.7 squared, and the standard deviation of y, which is 6.18 plus 2 covariant of x and y, which we already had 19.39 times the weight of y and x times the weight of y and x. So whatever you are getting, get the root of answer. Whatever you are getting, get the root of answer, and that answer will give you the standard deviation, and that answer will give you the standard deviation of the portfolio. 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 So let me give you another exercise. Exercise 2. Exercise 2. Do that one and see. So we have the weight 1 being 0.8. That is weight 1. We have weight 2 being 0.2. We have the standard deviation 1 being 5. Then standard deviation 2 being 6. Required calculate the standard deviation of portfolio. The standard deviation of portfolio required. Get the standard deviation. Get the standard deviation of the portfolio. Get the standard deviation of the portfolio. Get the standard deviation of the portfolio. So if you have our past paper, that is advanced financial management. Advanced financial management. You have the past paper of advanced financial management. The past paper of advanced financial management. So look at the question, May 2018 of the past paper. May 2018 of the past paper. They have given you the expected return of the portfolio, the standard deviation, and also they have given you. So get that one. And so examiner has just twisted that question so that you don't get misleaded. So expected return, because how do you get expected return if you have been given? How do you get expected return of one security? How do you get the expected return of one security? I want you to attempt that, to give tell that question. May 2018, May 2018, May 2018, question 2B, question 2B. Because examiner has not given you the weight of other portfolio, but how do you get the weight of a portfolio? Because we say expected return is equals to a weight times what? The expected return of the portfolio. So if examiner is not giving you this and they are giving you expected return and this, you can easily get the weight. You can easily get the weight by what? By substituting the formula. By substituting the formula. So once you get the weight of y, once you get the weight of 1, we always know that weight equals to 1. Weight equals to 1. So if I have weight 1, Then I will take 1 minus weight 1 so that I get the weight of 2, the weight 2, so that I get the weight 2. That's what examiner was trying to hide there. Then we have the efficiency security of the portfolio. So let's discuss something on efficiency. Efficiency security of portfolio. Efficiency security of portfolio. Efficiency security of portfolio. So you define and say, are those portfolios that dominate others in the market? So you define and say, are those portfolios that dominate others in the market, in terms of return and risk, Another point you say, in particular, they are the portfolios with, they are portfolios with, number one, the highest level of return, number two, the lowest level of risk, And then we have a diagram here which explains this efficiency of the portfolios, We have a curve here, this point, we have the point A, B, C, and D. We have point then this one will come this one. We have this point going this way. Okay. So say A, B, C, D, and then we have E, F, we have E, E, F, G, H, I, J, that point, J. So you can explain and say, so this one is return, and this side is a risk. So the first point you explained A, E, F, G, A, E, F, G. So we explained that one to say, they have the same level of return, and therefore A is a dominant, or a superior in terms of, risk. It has the lowest risk. So it is the dominant of, you see, it is here. So you see the level of, if we talk of this A, I hope you are reading this curve very well. This is the point of A. The level of risk is very small. And the expected return is high. Compared to G. Look at G. The level of risk is very high from here to here. So the level of risk is high, even though they have the same margin of return. So this A dominates this other, that is EFG. That's why we say it is these are those portfolios which dominate others in the market with the highest return and the lowest level of risk. And then we have this B, C, BHI. So we have BHI. So B is the dominant of H and I. So explain, say B. Another point you say B is dominant of H and I because it has the lowest risk and highest level of return, highest level of return. So examiner can ask you to explain the efficiency security of portfolio, explain the efficiency of the security of the portfolio using a diagram. So you will use that one to explain that. You will use that one to explain that one. That we have what is called optimum portfolios. We have what is called the optimum portfolio. To explain and say optimum portfolio are also known as optimum portfolio are also known as optimum portfolio are also known as the market portfolios. They are also known as the market portfolios. And we can define what is the market portfolio. You say a market portfolio is a portfolio that a market portfolio is a portfolio that is a portfolio that is a portfolio that contain is a portfolio that contain a portfolio that contain a security of a blue chip companies. That is good companies, a blue chip companies or good companies. So another point you say it is that portfolio that fall at the point of what? Tenancy, at the point of tangency, at the point of tangency of EF and C. So we have the point of tangency. We have what is called indifferent curve. I hope you have done a quantitative analysis and you understand what is an indifferent curve. You understand what is indifferent curve, or also you have done economics. So I want to look at what is called the capital market line. The capital market line. So let's have explanation of other concept here called the market line or portfolio equation. Market line or the portfolio equation. Market line, market portfolio, capital market line in private portfolio equation. In private portfolio equation. Then to explain and say a prudent investor will always combine risk-free, and the risky assets will always combine the risk-free and the risky asset in their portfolio. Then you explain and say the capital, another point, the capital market line CML, the capital market line in bracket CML is the light that passes through the risk-free return, the risk-free return and the market portfolio return point, and the market portfolio return, the return point, the market portfolio return point, and the market portfolio return point. So we have the efficient frontier curve, that is EFC, that is efficient frontier curve. Then we have another point which goes the I'm not good in drawing, which goes that way. That is called CML, the capital market line. So this point is what we refer as what? The capital market line, or the point. So how do we get this capital? So this side is return, this is return, and this one is risk, and this one is risk, that one is risk. So this one is called the market point M. So how do you get this? How do you get this CML? How do you get this CML? You check that is the risk-free rate plus in bracket return of the market minus the risk-free rate in bracket you multiply by beta factor. So another name of the capital market line, we have done what is called CAPM. So it is named as the capital appraising model. CAPM. So we take the risk-free rate E plus the return of the market minus the risk-free rate times the standard deviation of The standard deviation of B we divide by the standard deviation of M. That is the beta factor. That is the beta factor. So that is the beta factor. So we can have a symbol illustration. We can have a symbol illustration. We can have exercise 1. Exercise 1, you say, we have been given the portfolio. We have the portfolio. We have the portfolio 1, 2, 3. We have the portfolio 1, 2, 3. We have the expected return of this portfolio in percentage. Expected return of this portfolio in percentage 10, 12, 15. 10, 12, 15. We have the standard deviation of this portfolio. The standard deviation of this portfolio. We have 3, 6, 8. We have 6, 3, 8. And then we have additional information. Additional information. They have given us the expected return of the market. The expected return of the market is 18%. The expected return of the market is 18%. The risk-free rate is 6%. 6%. And the standard deviation of the market, is 4%. Is 4% required. Determine the required Roman 1. Determine the required rate of return. Determine the required rate of return